So let's take a look at the analysis first and remind ourselves of where we are and the position that we're trying to protect, or exactly what we're expecting in the position that we're trying to protect. We all remember this for our chart. This is actually taken a bit earlier. This is today's for our chart. We were looking at an inverted head and shoulder that should break higher above this neckline and move into a higher degree wave B here. Right, remember that the market had already finished the correction into a higher degree wave E here, A shown in red, and that we're expecting the market to do an A and a B and then a 1, 2 and a 3 to move all the way to wave C here, at least 54,000 and even 56,000. We were expecting that there was a wave 1 and a wave 2. This is shown here on that current count. This is an internal 1, 2, there's an internal 3 and an internal 4 and a 5. This is high degree 1. Market is still running into that high degree 2. Okay, so we were going to implement the hedge as of 46,000. We remember this. We can start implementing that hedge now, because this correction into wave 2 here showing in green is doing a very lengthy A and a B and now a very lengthy C. That C, according to this wave 1, can take you all the way down to 45,000 and even 45,457. Okay, so of course we will not sit on our hands and do nothing. If we're long at 50,000 and 49,000, we should start implementing hedges right now. Okay, so let's see how we could go about doing that, because we can do a little money on the side while we're waiting. Remember, this was expected to be an inverted head and shoulders. It can actually develop into a double head and an inverted double head and shoulders. This is what's actually happening right now. It could, that wave C has the capacity to extend. It's important to note on the 4-hour chart that momentum, this is taken just a while back, very close to the current market action. This is again today's 4-hour chart. Momentum is really contained above oversold. You can see it's very dismal and very poor negative momentum, and so we still retain on the longer term the bias for longs, that we will still hold our longs to see 52,000 and 54,000, but we would want to protect our position and also make money while waiting until this correction degree 2 and wave C into that 2 does complete. So on the 1-hour chart, we're looking at actually degree 3 momentum in a correction 4. What is a correction 4? Whatever is being contained here on that 4-hour chart, so long as it is above oversold, it is either a correction 2 or a correction 4. All right, so let's consider that this is the last correction that we should be seeing, or higher degree correction. So it's of course a wave, bigger higher degree wave 2, so it would be termed a level 4 or correction 4. Now this is going to be a flat, of course. So this is a 1-hour chart. You can see there was a very strong spike down. Now the market tried to correct, actually resisted, I believe, at oversold. Look, so this 30-minute chart resisted at around oversold and did another run down. Look at what we'll be doing. Okay, so there's still gonna be another wave 5 or into that C. That E can take you, we know now, to the bottom of wave 2, 45,457. Maybe even spike lower, we can get a lower head, 44,000. We remember that daily chart that we had earlier, where this correction actually takes off at 42,500. So if this was a wave A, that wave B can take you all down to 43,000 and so on. So we would want to make use of that situation. Okay, so that's what we're looking at now. This is the 30-minute chart. We'll begin to do hedge management. This was taken a bit earlier. It's very important in order to do, we remember we were going to be doing hedging at 46,000, so we can now do them a bit earlier at 46,800 and 47,000. Let's see how. All right, it's important to segregate the current leg C so that we are always selling into the last growth wave and the higher degree bearish motive. So according to this momentum plot here on that 30-minute chart, all right, there was a 1, 2, there's a 3, 4, and we're expecting a 5 down. We think that if we rise above this neckline, 48,000, the market becomes bullish. So anything below that 48,000 is a sell, consistent sell all the way down. That's what now you get to see. Remember, this is that same wave 3 that you're seeing here. You see here that label 3. This is a 3, 4. If we break higher above this line, most probably it's going to be a bearish, a bullish reversal if the momentum is right. All right, let's take a look at the cells themselves. So we had a 3, 4. There was now an internal 1, 2, an internal 3, and some kind of an ABC into a 4. Earlier, we could have sold just below level 3, hedged, that is 48,600, 48,432, 48,200. We could sell these levels, all right. And we would go just to 127.2, which is where the market is right now, 46,941. And 138.2, which is again where the market is. I don't know if it touched it or not, but probably would have tested this. 46,730. All right, so now we can redo that position. All right, we would always want to short into the last motive growth wave. You're looking at the motive wave on the 30 minutes and on the 15 minutes. So when we go live, we want to actually relate to this label 3 here. It's very important because this is the higher degree growth wave. It would mean that as you're moving out of that 3, you did a 1 and a 2 and a 3 and a 4 and a 5, and we're selling into, so if this was a 1 and 2, we're selling now into wave 3 inside of that high degree motive. Again, hedging. So to define hedging, now we can go live and see what we're going to be doing. To define hedging,